So welcome to Financial Analysis 101. Today we're just going to go over some basics, starting with ratio analysis. I'm going to get right into it. If you don't know who I am, my name is Aiden Hamlin. I have over 7 years of experience investing into equity markets. And my main goal, not here to get you rich quick so you can swipe away if that's what you're looking for. This is going to be a thorough educational content creation platform. That's a mouthful. I gotta fix that later. On just the basics that you should know before ever even thinking about managing a portfolio higher than VOO and BND. So if you don't have any experience yet, pump the brakes on investing into Tesla and Palantir. Just focus on building a strong portfolio using indexes as your basis. If you don't know what an index is, it's VOO. Buy it. DCA, stay away. That means dollar cost average, stay away. Just put $1 a day in, put $3 a day in, whatever your limit is. But enough talking about that. Let's get into my favorite topic, which is ratio analysis. So if you don't know what ratio analysis is, ratio analysis evaluates financial health using relationships between line items like liquidity, profitability, leverage, and you have vertical analysis where that expresses each financial statement item as a percentage of a base figure. So the entire thing is like a pizza pie, for example, and you want to think about it like how much of my pizza pie, aka my balance sheet, is assets, how much of that is liabilities. These are important factors when we look at the broad scheme of a financial statement because it's going to help us when we then look at things like horizontal analysis, which is looking at the trend of change that we see in things like vertical analysis. So it's a step-by-step process here. So you go into ratio analysis. That's going to give you things, again, you could use it differently in each sector. It's not all going to be the same. And your main goal is to just compare financial metrics derived from financial statements, while this one is going to express each item inside of a financial statement as a percentage of a base figure. Now, horizontal analysis, that expresses each item in a financial statement as a percentage change. That means, assets have grown 2% this year. That's one example of how you would look at that. Versus vertical analysis, that's like saying, okay, 30% of all of my equity in my balance sheet is assets. And then you have sector analysis. Sector analysis, it's more so using benchmarks. So what that means is you don't want to compare how Target's liquidity is compared to Tesla's liquidity because those are two different types of sectors. You are basically comparing apples to oranges. You always want to approach this comparing apples to apples. So keeping all of these key things in mind, we're going to go over a brief lesson on how to attack a company using these through financial statements. So now the income statement, that's all about performance over a period, like a movie of how the company made or lost money during a quarter or a year. If you don't know what a quarter is, it's 3 months out of 12 months, it's a quarter. Now, it starts with sales, aka revenue, which is how you're going to see it portrayed on an income statement. And then you subtract costs and expenses, and you end with either a profit or a loss. Now, a good thing to keep in mind here is that profits are good, but just because a company is not profitable doesn't mean you shouldn't be investing into it. All that this information does is give you insight, okay? So it really is just to show if a business is efficient in turning sales into actual earnings. So companies can make billions but still end with a greater loss than a company making millions because they might actually be profitable, which is a concept that if Congress knew, they'd do much better. But if you don't understand that, understanding how to read this statement is crucial. So just keep those thoughts in mind. Just taking income, like sales revenue, just taking away expenses that you basically paid to get to the sales revenue. Now, a balance sheet is a little bit different. You want to think assets like cash, properties, debts. So an example of that would be Joe's net worth is $1 million, including his cars and houses, even though he still owes money on them. So I'm sure you guys have to pay off a car. I'm sure you guys, not all of you, but I'm sure you guys understand the concept of paying off a house. That house is technically an asset that is still in your name. So the balance sheet shows what the company owns in their name and what it owes in debts, which is liabilities. So you have an asset and you have a liability. An asset is something that typically will appreciate over time, and a liability is something that is just a one-off expense, a large purchase, or a recurring debt that must be paid. Now, the big equation, assets equals liabilities plus equity. That's all you need to know. If you don't know how that works, just look at a bunch of different examples of assets equals liabilities plus equity. I promise it's not as jargon and as difficult as that might sound. Now, a cash flow statement, this is really important. You need to understand a cash flow statement because some investors would argue it is the most important factor that tracks the actual cash moving in and out over a specific period. Okay? I had the flu. It's terrible. So, profits on paper don't pay bills if cash is all tied up. Okay, so you can have a bunch of assets, but if you can't pay for your water bill, they're going to take that house away. So you need to make sure that your cash isn't tied up, which is why a cash flow statement is really what a lot of investors on a grand scheme are looking at. You know, you talk about more complex ideas like discounted cash flows, and we'll get into that part next. But for now, I just need you to understand that you have operating, which is day-to-day cash flow statements. You have an investing cash flow statement, which is buying and selling assets. You know, things like gold chains and houses, which aren't that liquid, but you can still sell within less than a year, so they're technically liquid. And financing, you know, loans, dividends. These types of things are classified into three different financial statements as a cash flow statement: cash flow from operations, cash flow from investing, and cash flow from financing. Now, if companies have no cash flow, bills don't get paid. And if bills don't get paid, companies go under. So, understanding how to utilize each financial statement brings you closer to not only understanding, but learning how to understanding a business, but understanding how to efficiently run one yourself. So, even if you're not into stocks, understanding what an income statement is, what a balance sheet is, and what a cash flow statement is, it's just going to make you that much better at learning how to manage your finances or your business's finances. You can break down your income and clearly see, okay, I made this much money from my job. I've gained this much from my, you know, whatever it could be. It could be, you know, money that you get for Christmas. It's a gain. It's a financial gain in an income statement. And then expenses. That is what kills 60% of Americans. Expenses. How much money are you spending? And if you're spending too much or more than what you are making, stop. Don't do it. Don't be Congress. So just keep that in mind. You want to understand how all of these tie into one another. So we're going to go into the next slide now to break that down. So I want you guys to think about which statement would you think is a company's a snapshot of a company's value at the end of the year or the period. Okay, so remember, we're talking about value. So how much are you worth? How much is the company worth? Now, question two is which one cares or which statement cares about actual cash and not just profits? And then question number three would be why might a profitable company with a great income statement still go bankrupt? If you can answer all of these three questions, you have a better grasp of financial statements than I would say 60% of people who graduated with a finance degree because they don't even, once they get their job doing whatever outside of finance, they don't remember these basic principles. So if you want extra knowledge or you want to feel more fortified in understanding how these financial statements work, I just want you to take a beat, pause and in your own words try and jot down the difference between an income statement and a cash flow statement, and also jot down the importance of understanding a balance sheet, income statement, and cash flow statement. So now I'm going to leave you guys with a gem here before I cut the video slightly short, and it's ratio analysis. So it's the quick math that tells you a story, and this is one way that you can value a company and have much more insight than most investors do when investing in a company. So you have liquidity ratios, profitability ratios, and efficiency ratios. Now, liquidity ratios is just how easily can the company pay short-term bills, right? So an example of that would be the current ratio. That basically is the current assets divided by the current liabilities. And where do you find that? You would find that in the balance sheet, right? So you would find that in the balance sheet because it's talking about assets and liabilities. So understanding how liquid a company is, how quickly can you pay bills in time, if your current assets to current liabilities is 2, that means for every dollar owned, there's $2, or I'm sorry, $1 that is owed, in debt. There's $2 available to pay it. So it's like having twice the cash you need for rent at all times. That is a very good position to be in for some companies. And other companies, it might be a little bit too frugal and they might actually hurt their growth, which is when we bring in things like sector analysis. Now, profitability ratios. Is the company making good money? So an example of that would be return on equity. So you have, for return on equity, net income divided by shareholders' equity. So a 15% return on equity means for every $100 owners invested, they got a $15 profit in return. So just think of it as if I put $100 into my bank savings, I get $15 at the end of every year, which is not going to happen. You're not going to get that from a bank savings account. And then you have an efficiency ratio, but it's important to understand this because if a business can do that, that means that if they give out things like dividends or their equity is growing, that is a great position for you as the investor to be in. Now you also have an efficiency ratio. An efficiency ratio, that is going to be, if a business has assets or inventory, how well do they use them for the sale or for sales? How well does the company use its stuff, in other words? So an example is inventory turnover. So if cost of goods sold, inventory turnover, the equation for that is cost of goods sold divided by average inventory. If it's 5, that means that the company sells out its stock 5 times a year. So it's like a grocery store restocking their shelves 5 times over, which is in some cases very quick, in other cases very bad. If you're only selling and turning over milk 5 times in a year, it's probably not the best grocery store. Probably wouldn't buy groceries there. The milk is expiring, But if you can understand, a real example would be for a company like Starbucks, a high profitability ratio shows that they're great and their coffee sales are boosting through the charts, and it's essentially showing you that you don't have to worry about their profits because their profits are strong. But then that brings and burdens the question, well, how should I value a company if their liquidity is weak but their profitability is strong? The answer to that is you have to actually look at what a sector's benchmarks are, which brings in sector analysis. And we'll get more into that in the next video.